Hi and welcome to the latest podcast. We trust you'll find this information on Rentvesting both informative and valuable when deciding if this property investment strategy is appropriate for you. Now, as you listen to the podcast, please make a note of any questions you have and then email them to hello@mrdpartners.com.au and we'll be back in touch to answer them individually. But for the sake of keeping this brief, we're not going to have a Q&A session as part of today's podcast. Before we start, I'd like to draw your attention to the disclaimer on the screen. Now, today's podcast is not supposed to be a substitute for professional advice. Rather, it's educational information that's designed to challenge mindsets or paradigms and help people get into the property market or add to their existing property portfolio sooner. And firstly, for the benefit of those not familiar with MRD Partners, we are a boutique family business now in our 16th year of operation, and we've been committed to partnering with and supporting property investors since the 15th of May 2002. Now, while our industry peers tend to focus on transactions, that is, they'll sell you a house or a unit or whatever, but you won't hear from them again unless you make contact because you want to buy or sell another property. That's traditional real estate. The MRD way is to actually partner with you. First of all, to help you get clear about what your goals are, to creatively strategize with you so that you can achieve those goals over time, and to give you financial choices that most people will sadly never have. We teach the responsible use of the right kind of debt to build wealth for you and your family's future. Rentvesting is a new property strategy for savvy Australians. And in this podcast, you're going to learn a bunch of things, including what exactly is this new, or actually is it an old strategy that 13% of Australian property investors are doing? And while the term rentvesting is new, the concept has actually been around for a long time, just not discussed very much. Katrina and I have been, or were, rentvestors for a number of years from 1999. Okay, we're going to look at how this will fast track your efforts to build wealth and how the strategy can assist you to reach your end result with more certainty and sooner. We're also going to hear some real life case studies about real people who have created financial success with rentvesting. Knowing their story will allow you to follow in their footsteps. You'll also want to know of any barriers, obstacles, etc. that are in the way of the strategy working for you. And perhaps unsurprisingly, you're going to learn that the biggest barrier to your rentvesting success is you. Yep, that's right, you. But more about that later. Okay, so this podcast is for renters who are currently locked out of the property market, homeowners who want to free up cash flow, anyone wanting to speed up the building of an investment property portfolio for the purposes of creating wealth. And definitely the podcast is for the mentally flexible. That's people willing to look outside what they currently already know about building wealth with property. A little bit about me. My name is Nick Lockhart. I'm a family man. I've been married for over 30 years and I have 4 children. I'm mad keen about property, or more importantly, what investing in property will deliver when it's done the right way. And this is actually why I founded MRD Partners over 15 years ago. I love bringing sound education and real wealth strategies to people's lives, something I do every day. I have skin in the game, meaning Katrina, my wife, and I are investors with our own property portfolio, and currently we're helping our son and his fiancée buy their first property. And in my personal property investing journey, I've had to challenge myself and be willing to learn new ways of thinking. This required, I suppose, mental elasticity on my part, and I'll talk more about my biggest mistake that I made when it comes to investing in property later. Australians currently have an obsession with property, but it was the the grandparents' generation, our builders, we call it the builders' generation, that set up the Australian culture to be fixated on owning and living in the home that they own. That generation aimed their focus squarely on putting kids through school, paying off the only home that they lived in generally for the whole of their 30 working years, probably more than 30 working years, 40 working years, and also working one job for most, if not all, of their working lives. So upon retirement, the plan was generally to sell the family home, downsize, and maybe take a holiday. But overall, that generation did not aim to own an investment portfolio. Something really important to take note of, our grandparents downsizing because their home is too big for them, which is something we hear quite often, is a little bit of a stretch of the truth at best, or maybe at worst a complete fallacy. I think in reality most retirees downsize because they can't afford to retire and maintain a lifestyle anywhere close to what they had previously enjoyed. But think about this, if people were to retire with the same income that they had prior to retirement, I think a lot more would be content to stay in the family home, at least for a lot longer. So let's look at Gen X and the millennials, Gen X being those aged from 33 to 52 and the millennials 13 to 35 currently as of 2017. These generations, well, the adults anyway, maybe not the 13-year-olds, want regular overseas travel, and to do that requires great cash flow and flexible, perhaps even non-traditional working arrangements. People in these groups are far more likely to seek out employment that allows them to work remotely, and they'll probably have between 5 to 10 career and or job changes throughout their working lives. And the people in these groups want to build property portfolios and they want to do it quickly. Patience is not a virtue. They place very high expectations on themselves. They want to get things done and they want to get it done now. People under 35 are noticeably more mentally flexible when it comes to earning an income. They're more prepared to look at entrepreneurial opportunities, look at the share market, property market and so forth, than the traditional just go to work and get a job of previous generations. And thanks to skyrocketing property prices, making it harder and harder to find or for first home buyers to enter the market, together with antiquated philosophies on property investing that's really more based on a property buying model that our grandparents or parents did, means that those two generations are quite disadvantaged. Unless they have a mental adjustment, they may miss out on opportunity. And I suppose it's the mental adjustment in part that this podcast aims to address. And so let's do that. Let's look first of all at the some of the social and or cultural norms that have changed in our society today when we look back a couple of generations and compare with our grandparents. Now, there's a question on the screen that says, why are 87% of today's property investors still using the same strategy our grandparents used? Well, you might think, well, why wouldn't they be? Well, everything else seems to change, so why wouldn't that change, potentially? Like, for example, marriage is no longer necessary. Same-sex marriage is accepted. The way we raise children is greatly differed. I mean, naughty kids back when used to get a smack. Now they get time out in the corner. Do we vaccinate our children or do we not vaccinate our children? Do we eat animal products, meat, dairy and so forth? Or do we live a plant-based vegan lifestyle? Today, people quite often work remotely, work from home or work on the road, work from tablets, etc. Maybe they have a home-based business or more than one home-based business. People can choose their religion and not feel ostracized or segregated because of it. Today, there is a complete obsession with social media and an incredible importance to share your breakfast on a weekend. And today, fame, or perhaps being infamous, almost rivals and supersedes statesman-like chivalry or academic qualities. And yet the one cultural norm that still lingers is the notion that you are a successful Australian if you buy a home and live in it. Now, we've thrown everything else out that doesn't work or that we didn't like, but this one still lingers. It actually lingers in an ever-increasing number. And the irony is, it isn't actually working for so many people. People buying and living in their own home is the very reason, in my opinion, why so many are broke and will never get ahead. They spend their working lives bringing home enough money just to pay the bills and the mortgage. And there's never enough left over to invest. So what is exactly this thing called rent vesting? What does it look like? Well, a simplified explanation is as follows. You purchase a property, you put a tenant in it, you claim the maximum tax depreciation, and you leave the tenant and the taxman to pay most, if not all, of the property expenses. You rent where you want to live, and in what you want to live, that is, whether it be acreage, high-rise with ocean views, etc., and then you repeat those steps. Purchase another property, put a tenant in it, claim maximum depreciation, let the tenant and the taxman pay most, if not all, of your expenses, and let time and inflation drive the value of your assets up and build wealth for you passively. Sounds easy, doesn't it? Well, you'd think so, but it really couldn't be that easy. If 87% of Australian property investors are still purchasing property and not questioning the strategy that their parents and grandparents followed before them. Now, tradition and good old-fashioned emotion dominate people's decision-making, and mostly they choose to live in the property they buy. Now, while this would be seen as achieving the Australian dream, that is, to live in your own home, for many it actually turns out to be a nightmare disguised as a dream. Why? Just for the reason I said, it's the very thing that dogs them, holds them back, and prevents them from actually making investment decisions. Now, before you think I'm anti-owning your own home, I'm not. I'm anti-living in the home you own if that is the thing that's preventing you from building wealth. Okay, before we look at a couple of case studies, I want to look at the whole concept of jumping over rocks and through hoops and so forth. Now, while rent vesting is a very, very simple strategy, it has a poor take-up due to its obstacles and hurdles. So let's look at what they are. I say they, but really there's only one major obstacle that property investors need to be aware of before they consider taking advantage of this strategy. And I suppose we could summarize that as a paradigm shift. It's a mindset, a way of thinking, a fundamental change in approach or underlying assumption. That's the definition. A paradigm shift is a fundamental change in approach or a fundamental change in underlying assumptions. This strategy of rent vesting will require a paradigm shift more than likely. Because the underlying assumption is that to be a successful Australian, I must own the home that I live in, or that I could never be happy or truly content living in a rental property. And we think like that because we continue to operate within tight, socially and culturally accepted boundaries. And we do this subconsciously without even thinking about it. But if we want to move forward, if we want to bring about meaningful change, and if we want results to be different, then we must adopt new strategies. We must learn to stop automatically being a particular way and instead consciously choose to be different. We've got to break habits. When you jump in a car and drive to work, do you ever get there and think, I don't even remember the trip? You don't remember putting your seatbelt on, indicating, changing gears. You just went on autopilot. Well, that's okay, but don't let life continue to go on autopilot if it's not taking you to where you want to go, if it's not taking you closer to the end game. We must consciously and intentionally change habits and be different until the new way of thinking and being and acting becomes the habit, and that becomes our autopilot. And then we're on track for great success. Your worth or your value as a person is not rooted in whether you live in the home you own or not. Rentvesting is merely an opportunity that's there, ready and available for you to take advantage of. Instead of focusing on immediate or short-term gratification, if we would all make a decision on a daily basis to have a longer term and longer lasting view and say what the decisions that are in front of you today, what's going to be in your best long-term interest? If you can make those decisions, I think you'll do a lot better. Okay, so I'd like to introduce you to our first young investing heroes, Adam and Jasmine. Age 33 and 30 respectively. Their occupations are sports performance analysts and she's an events coordinator. They live in Qatar in the Middle East. Their goals and objectives were building up their careers overseas and building a property portfolio back here at home for when they return. They've bought 2 investment properties. One's on Brisbane's north side and the other is a northeastern built-out suburb of the Gold Coast. They paid approximately they paid $360 for one and approximately $408 for the other. And the rental yields you see there, 5.2 and 5.34%. Now, I've used Matusik Insights research, and it says that Brisbane housing prices are anticipated to grow by 7% over the next 3 years between 2017 and 2020. So that would equate to a $25,000 boost in personal equity over the next 3 years on their Brisbane property. Gold Coast townhomes are anticipated to grow by 15% over the same time frame. So that means for Adam and Jasmine, it would be a $61,000+ equity growth over the next 3 years. So what that means is that while Adam and Jasmine are busy building their careers, enjoying time living and working overseas, they're going to potentially create in excess of $86,500 of new property wealth, and all from small deposits that if had been left in a bank would have earned them 4/5 of not much at all. Okay, so now I'd like to introduce you to our next young investing heroes, Jason and Stacey. They are aged 28 and 26 respectively. They live in Sydney in a suburb called Paddington. He's a digital designer and she's a fashion editor. They are busy chasing their careers and doing incredibly well, progressing in those careers, loving living in Sydney. Neither of them are from Sydney, but they love living and working in Sydney. But it's not a place that they could afford to invest. Both of their investment properties are in Brisbane. One is in a suburb on Brisbane's mid-north side and the other in the southwest growth corridor. The prices of those properties were just under $352,000 and just under $322,000 respectively. Rental yields 5.1 and 5.3. Again, using Matusik Property Insights and the 7% growth rate in Brisbane, that means that on property 1, they'd make over $24,500 equity, and property 2, $22,500 equity over the next 3 years. That is a total of $47,000 in potential new property wealth, while Jason and Sydney are busy going from home to work, work to home, home to work, work to home, home to work, work to home, busy just in the rat race like everybody else, building their careers, still in their 20s, living a great double income, no kids life in Sydney. Again, a place that they couldn't afford to buy. I suppose the only thing left to say is I wish my generation had been as savvy as these young people today. Well, if not my whole generation, I certainly wish I had been that savvy. Unfortunately, I had no clue whatsoever back at that age that this was an option for me. Now, I spoke about jumping over rocks and through hoops and your biggest obstacle being the need for a paradigm shift. There actually remains another pitfall when it comes to rent vesting. It's people. Let's call it your best mate, family members, friends, co-workers, neighbours, Facebook community. Doesn't matter. Auntie, uncle, butcher, baker, candlestick maker. It really doesn't matter. But unfortunately, most of the people who are in your world, those close to you, are not going to understand and probably won't agree with the rent vesting strategy, which means that you're going to need to be able to deal with not being understood or admired by those in your world. So question, are you going to let the opinion of others, people you care about and respect, I'm not denying that, but are you going to let their opinion hold you back and determine your future, or are you going to follow your convictions? Choosing to become a rent vestor needs to be intentional and strategic, and it does not render you a second-class citizen. Now, I was in Cairns with my wife holidaying. We just arrived, got into our room. I hadn't even unpacked and my phone rang. It was the neighbour. And she was asking, are you home at the moment? And I said, no, we're on holidays. And she goes, oh, lucky you. And she goes, so you're not hearing all the noise coming from your home? And straight away I knew James, my son, was drumming. So I said, oh, is James drumming, is he? And she went on and on and on about it and carried on, which was fine. She can do that. I mean, it's a bit silly. It was the middle of the day. But then she said, we bought our house. I think she said it more like, we bought our house. What she was saying is, you're a scumbag renter, but we actually bought this house and we wanted peace and quiet. Fortunately for me, there was a really bad reception and the line dropped out, and I never spoke with her again. We moved, we got home, and I just didn't bother talking to her. I didn't know what to say. But I didn't care. I didn't care that she thought I was a renter. She had no clue that we owned multiple properties, and we did so because renting gave us the cash flow to do it. But her opinion didn't matter. But imagine if it did. Imagine if it really bothered me what somebody thought. Today we could be in a situation where we're living in our own home, which we are now, but where we're living in our own home but without the property portfolio that we've been fortunate enough to build. So my recommendation, talk to people who are in the game of property investing. Don't talk to people who aren't. And preferably only speak to people who have used rent vesting to fast track their wealth creation. Listen to the opinions of people in the game of property and ideally rent vesting who are making decisions, taking risks, weighing up data, so that they're making wise, informed decisions, because it's their footsteps you want to follow in. Now, there is always going to be a cost. Perhaps it's an opportunity cost that comes when we take advice from the wrong people. And remember, the wrong person that you've been listening to and has been holding you back all of this time is probably you. That's right, yourself. Now, when I was younger, without the expenses that came with starting a family, investing was not on my radar, as I mentioned earlier. By the time I was 30, I was married with 2 children, living in the home that we'd built, and I began to recognize the importance of doing something about my future. Investing suddenly was on the radar, but I told myself that I couldn't afford it. I reasoned one mortgage was difficult enough, and there was no way a bank was going to give me another one. Then at 37, I actually began working in the property industry, seeing what other people were doing. And after doing this for a few years, now with 4 children at a private school, I continued in my wrong assumption that we didn't qualify and nobody would loan us the money and we wouldn't get an investment property. I was speaking on many, many occasions at property seminars. I would be asked to come and speak and do a cameo presentation just on property research and where I was researching and what my research was unearthing. I was also putting together some developments, finding the land, sourcing, etc. And I was talking about these developments and so forth. But I still wasn't investing myself. At the end of these events, the main speaker would tell the audience that their first step was to have their borrowing capacity assessed. They were asked to complete a form that would give a snapshot of their financial position so that a qualified professional could assess their current position. And I don't know why, but one day the penny dropped. I'm sitting there and I thought, I've got nothing to lose. And so I had Katrina's and my borrowing capacity assessed. Subconsciously a part of me had not done it, I suppose, because I was expecting I was going to be rejected. And we all try to avoid rejection if we can, and we know it's coming. But when that assessment was done, not only did it come back saying, yes, I could afford to buy an investment property, but to my utter surprise, we could afford to buy two. I suppose what I didn't get was the power of the tenant and the taxman picking up most, if not all, of the costs. I just thought owning a property was going to put a huge cost imposition on me, but it wasn't. So I was actually 40 when I finally became a property investor. I'd lost 10 years of potential property growth opportunities. Had I taken action a decade earlier, the equity we would have amassed would have allowed us to invest into more properties and to do it sooner. And it goes without saying we'd have more equity today in all of those properties. More property equals more equity, equals more wealth, equals more lifestyle choices, which is ultimately why I do it and you do it. It's choices that it gives us. So we do learn from mistakes, and yes, I learned from my mistakes, but what I'm encouraging you to do is to learn from mine as well. It always costs a lot less money when you learn from other people's mistakes rather than having to pay the price yourself. So the MRD way is to offer you the support through our partnership so that you can live each day confident in the knowledge that your action plan is being implemented the right way. Of the many MRD clients that we partner with, those who achieve the greatest outcomes followed a pretty simple formula. Firstly, we take them through an in-depth discovery session, a fact find you can call it, which is to determine their starting position and the most appropriate way forward. From there, we devise a plan or a blueprint, and finally, we intentionally action the plan together. And of course, we do regular reviews to tweak the plan as necessary. This is to ensure that as changes occur to someone's circumstances and situations, they remain on track. And of course, lending rules are changing and new offers are out there all the time. So we're forever looking for new, cheaper, better products for clients as well. But right now, your next step is incredibly, incredibly simple. And that is to determine your borrowing capacity. With your situation exactly as it is now, with no change made. But what if? What if you do own a home and you were to move out? And you were to live in it, sorry about the motorbike. So what if you were to live in a home and move out and move into an even nicer property, maybe with a pool or maybe with the media room or something else, save money and get tax deductibility on all of the expenses around your own home. So what we would do is we can look at your borrowing capacity assessment. We can do some what if. What if your circumstances changed? What if you were to move into a rental property, for example? Successful property investing is possible, and it will be your experience if you do it correctly. So please, don't be like me in my 30s and talk yourself out of further investigation, but take up my offer to illuminate what might be. Look into your future and see what possibly could be. At the end of the day, though, just do something. At MRD, we've got proprietary in-house software that offers you powerful insights into your future. And we're happy to use that and do some modeling with you. But ultimately, the ball is in your court now as to whether you log off and go back to more of the same, where nothing changes, or whether you use the link below to request your borrowing capacity be assessed. We call it a My Starting Point, because that's what it is. It's your starting point. Well, that's it for this podcast. I trust you gained some great insights from it. All the very best for the greatest of success in your own investment journey, and I look forward to speaking with you in the near future. Bye for now.